Have you ever actually stopped to ask who's paying for the AI boom? It's not venture capital, and it's definitely not OpenAI, a company on track to lose around $14 billion this year. So here's the question nobody wants to sit with. What if the people quietly funding the biggest spending spree in the history of capitalism are three people who never signed up for it? The one paying into a 401k, the one paying an electricity bill, and the one left holding the bag when the music stops. What if it's you? Because there's a trick nobody on CNBC will say out loud. When Microsoft, Google, Amazon, and Meta tell you they're spending close to $700 billion this year on AI, your brain hears rich companies spending their own cash. That's not what's happening. A huge chunk of that money isn't theirs, isn't on their balance sheets, and the bill is being quietly routed to your 401k and your power meter. By the end of this video, I'm going to show you exactly how that wire transfer works, because once you see it, you can't unsee it. To understand who's actually paying, you have to understand what these companies are actually buying. In 2025, the four biggest hyperscalers, Microsoft, Google, Amazon, and Meta, spent over $300 billion combined on capital expenditures. That's the accounting line for big physical stuff. Data centers, servers, chips, power. A lot of money, but a normal amount of a lot of money. Then the AI arms race went nuclear. By 2026, those same four companies are guiding toward roughly $725 billion in a single year. In 2 years, the spending didn't grow. It nearly quadrupled. Amazon alone is targeting around $200 billion. Microsoft, $190 billion. Wall Street now thinks the industry blows past $1 trillion a year by 2027. In 2024, most of that $200 billion was ordinary cloud plumbing, servers, storage, the everyday cost of keeping the internet running, with AI just a slice of it. What flipped is what they started buying. After ChatGPT, the money moved into NVIDIA AI chips. And not just a few chips. These things can cost tens of thousands of dollars each. Big tech orders them by the hundreds of thousands. Then it has to buy the power to keep them running. Here's the tell. NVIDIA used to sell around $15 billion of data center chips in a whole year. Last quarter, it sold more than $62 billion in 3 months. These companies stopped buying servers and started building what NVIDIA's own CEO calls AI factories. To put that in perspective, JP Morgan found that tech capital spending drove 40 to 45% of all U.S. GDP growth over the last 3 quarters, up from under 5% back in 2023. Read that again. Nearly half the growth in the world's biggest economy is now leaning on warehouses full of chips that didn't exist 3 years ago. And here's the part nobody spends enough time on. These are not the careful, return-obsessed bets Wall Street usually rewards. A lot of executives are openly calling this a land grab, and every quarter, the spending targets keep moving higher. At the same time, their spare cash keeps disappearing. That is not the body language of a confident investment. It looks more like someone maxing out a 4th credit card, because they are convinced the next bet will pay for all the last ones. So now you have one of the most expensive build-outs in corporate history. It is growing faster than revenue. It is growing faster than profit. And the people running it are basically admitting the same thing. They are spending because they cannot afford to fall behind. Which leaves one obvious question. Where does all the money come from? Because $700 billion a year is not sitting in big tech's couch cushions. These companies are rich, but they are not magic. If the spending keeps rising and the spare cash keeps shrinking, somebody has to fill the gap. And the way they fill it is the actual story. Let me walk you through the AI money machine. We'll use one character. Call him the hyperscaler. The old way was simple. A tech company made a profit. It took its own cash, and it built a data center, boring, clean, and limited by how much money the company actually had. If you generated $50 billion in spare cash, you could build $50 billion of stuff. That was the speed limit. Reality had a speed limit. But $700 billion a year blows straight past that limit. Take Amazon. Its free cash flow, the actual spare cash left after running the business, collapsed to around $1.2 billion over the past year, down from $26 billion. Why? Because Amazon plowed nearly every dollar it earned into AI gear, and analysts expect that free cash flow to turn negative this year. Meta has a similar problem. Barclays sees Meta's free cash flow dropping almost 90%, and Alphabet's free cash flow is on track to fall towards zero. So these companies are still spending, but the spare cash is no longer just sitting there. That is the problem. So they built a workaround, and it is dark, but it is also kind of elegant. Instead of putting the data center on its own books, the hyperscaler does something else. It teams up with a private credit firm like Blue Owl, PIMCO, BlackRock, or Apollo. Together, they spin up a shell company. In finance, this is called a special purpose vehicle, or an SPV. That sounds technical, but in plain English, it means one thing: a company built to do exactly one job, and then quietly disappear into the background. The shell borrows tens of billions of dollars from investors. The shell builds the data center. Then the hyperscaler simply rents it back. Now watch what just happened. The building got built. The chips got bought. The work is identical. But the debt is not sitting on the tech company's balance sheet. All of it sits inside the shell. And this is not hypothetical. Here is the real version. When Meta built its Hyperion data center in Louisiana, Meta did not borrow the $27 billion itself. A shell company called Beignet did. Meta owns just 20% of that shell. Then Meta leases the finished campus back. So Meta gets the data center. But the debt never touches Meta's books. Meta is not the borrower. It is the tenant. The kind of tenant who somehow handed the landlord the entire mortgage and still kept a key to the front door. And this is not some fringe maneuver. In roughly 18 months, tech companies have moved more than $120 billion of data center debt off their own books and onto Wall Street, using this exact structure. Meta's Hyperion deal was the biggest private credit deal ever done, and even Moody's has warned that the disclosures may not show the full picture of what these companies actually owe. So the core trick is simple. The spending shows up as exciting growth. The debt disappears into a shell, and the risk gets handed to whoever buys the bonds. But before you can see why that becomes a problem for you, specifically, you need to see why this whole machine might be standing on quicksand. The story you're sold is that the smartest, richest companies on Earth are making bold bets with their own money, and free markets are funding the future. That's the costume. Underneath it, three things are happening that nobody puts on a Chiron. First, a lot of the demand might be fake. This is the part that should rattle you. A big chunk of this demand is circular. The companies are buying from each other in a loop. NVIDIA announced it would invest up to $100 billion in OpenAI. OpenAI then turns around and spends on NVIDIA chips. Oracle signed a $300 billion cloud deal with OpenAI, then spends billions on NVIDIA chips to deliver it, sending the money right back to NVIDIA. AMD literally handed OpenAI warrants for about 10% of AMD stock at 1 cent a share, which is a tenth of a chip giant for less than the coins in your car's cup holder, in exchange for OpenAI promising to buy AMD chips. When a supplier pays its own customer to buy its products, that's not demand. Picture your boss handing you your salary on one condition. You have to spend all of it back at the company store. Then he tells the shareholders, demand is booming. And if that sounds like some shiny new trick, it isn't. It's the same vendor financing that inflated Nortel in the dot-com bubble, lending customers the cash to buy its gear so the order book looked real, just with GPS today, instead of telecom switches. That story ended with Nortel in bankruptcy, broken up, and sold for parts. Even NVIDIA's CEO has started edging toward the door, saying his $30 billion in OpenAI might be the last time. And by early 2026, the $100 billion deal was reportedly on ice. And the customer sitting at the center of this whole loop? OpenAI. OpenAI has committed to roughly $1.4 trillion in spending over the next several years, but its annual revenue rate is only around $25 billion, and it is still losing money. For that math to work, OpenAI does not just need to grow fast, it needs to grow into something close to Google. That is not really a business plan. It is a vision board with a $1 trillion price tag. Now, if shaky demand sounds scary, wait until you see what it does to the numbers you actually trust. Because second, the profits might be distorted too. And this is not just me saying that. It is Michael Burry, the guy who called the 2008 housing collapse. His point is simple. These AI chips wear out fast, and they can become obsolete in 2 or 3 years, but some companies are depreciating them over 5 or 6 years. Stretch the timeline, and the costs look smaller. The profits look bigger, and the business looks healthier than it may actually be. It is like buying jeans that fall apart in 3 days, then telling the taxman you plan to wear them for 6 years. Burry estimates that this could understate costs by around $176 billion between 2026 and 2028. Enough, he says, to inflate reported earnings across big tech by roughly 20%, with Oracle and Meta among the worst. He called it one of the more common frauds of the modern era, and now he is holding put options against NVIDIA and Palantir. So how does all of this actually reach your wallet? The shells, the circular deals, the debt nobody puts on a balance sheet. There are 4 ways, and they are already happening. First, your retirement account. The Magnificent Seven now make up roughly a third of the entire S&P 500, so if you own an index fund, you are exposed. And if you have a 401k, you almost certainly own one. That means you are heavily exposed to these AI bets, whether you chose them or not. If the build-out pays off, great, your fund benefits. But if the accounting questions come due, your so-called diversified fund can sink right along with it, because diversification does not help much when the same 7 companies dominate the index. As one portfolio manager put it about these mega listings, your 401k is the exit liquidity, then your electricity bill. This one is not a theory. It is already printed on people's statements. Goldman Sachs found that power prices rose 6.9% in 2025. That was more than double the rate of inflation. And data centers are driving about 40% of the growth in electricity demand. Near data center hubs, wholesale power prices have run as much as 267% higher than they were 5 years ago. Then there is Manassas, Virginia. A man opened his January power bill, $281. The month before, it was about $100. He did not move. He did not build a backyard roller coaster, but somewhere nearby, a data center quietly decided his wallet was part of the grid, and data center power demand is still rising, fast. So someone has to build all that new electricity. Someone has to pay for the grid upgrades. Guess whose bill it lands on? Then the bond market. Remember that $120 billion of data center debt sitting inside shells? It did not disappear. It was bought by pension funds, insurance companies, credit funds, the same kinds of institutions that manage ordinary people's money. Meta's Hyperion bonds carried an investment-grade rating, but they priced at a yield near 6.6%. That is getting close to junk territory, an investment-grade stamp with a near-junk yield. That is the bond market quietly saying, dressed for the office, priced like it just got laid off. And if these data centers do not earn what was promised, the losses do not stay inside some abstract Wall Street machine. They land in the boring funds quietly holding your future. And finally, your job and your prices. Meta is cutting 8,000 jobs, partly to offset this spending. And because AI CapEx is now propping up so much of GDP, If it slows, the whole economy feels the drop. You never got a vote on any of this. You're just paying for it. Let me name the rule. The pattern here is older than AI. Every boom eventually runs out of its own money, and when it does, it usually does not stop. It goes looking for someone else's. In the dot-com bust, it was the Nortel playbook. Fake demand was propped up until the whole thing collapsed. In 2008, it was mortgages, sliced up, repackaged, and stamped as safe. Today, it is GPS depreciated over 6 years, demand looping between the same handful of companies, and debt buried inside shells named after pastries. Different costume. Same trick. Privatize the upside. Socialize the risk. That's the line that matters. The people building this keep the equity, the bonuses, and the headlines. You get handed the risk, and nobody ever asks if you want it. The real genius is that it never looks like you're paying. The money runs through a shell, then an index fund, then a utility bill. So by the time it reaches you, there's no name left on it. So the next time an AI headline sells you the future, remember who's actually footing the bill. The saver, the ratepayer, the one left holding the bag. All three of them are you. If you want to understand this machine before it breaks, instead of after, subscribe and turn on notifications. I cover what the financial media will not, because the real risks in markets are never the loud ones on the ticker. They are the quiet ones, the ones buried in the footnotes, the ones hidden inside shell companies, and sometimes the ones hiding inside a company called Beignet.